This is the current federal tax developments for the week of January the 4th, 2021. Current federal tax developments are brought to you by Kaplan Financial Education and by your state society of CPAs. I'm Ed Zollers. We're going to take a look this week, after going through our bills last couple of weeks, at more traditional new developments that we have in the area of tax this week. So we'll take a look at a few things. And some of what we're looking at this week will include we have the final small business accounting method regulations were issued this week. So we have some stuff there that's going to talk to us about how we deal with small business accounting methods put in by the Tax Cuts and Jobs Act, and more specifically, the problem we had with syndicates that we discussed earlier. We're also going to discuss the fact that the IRS proposed this week to do a user fee for the estate tax closing letters. So we'll talk about what that means and how that works. We're going to go back to a case we looked at back in March of 2019. This case, the Third Circuit Court of Appeals has overturned the tax court's published decision on whether or not the taxpayer had managed to adequately inform the IRS of a change of address. And we'll talk kind of briefly about what that means and who it might be important to and who it might not be, given the nature of a published tax court decision. And on the other side, that decision being overturned by a specific court of appeals. We're also talking about an interesting IRS memo. It actually was an email, but it analyzes the due dates for claims for refund for 2019 returns that were filed on extension. We're not on extension, but were filed in July on the non-extension extension, and try to figure out how that's going to work for us. And finally, the Financial Crimes Enforcement Network, or FinCEN, announced this week that they plan to issue regulations that is going to require you, if you're holding a cryptocurrency, if you have an account holding cryptocurrency that's a non-US account, that you'll have to start reporting that on the FBAR, though we don't know when yet. So we have some opening things to deal with. So let's go ahead first and talk about this small business accounting method final regulations that were released this week. Now, you may remember we discussed these back in July when the IRS issued what was then the proposed regulations for the change of account for the small business accounting methods. If you recall, the Tax Cuts and Jobs Act, if you are a qualified small business, meaning you have average revenues for the past 3 years of less than what was $25 million per the act, but it's inflation adjusted. So now we're up to $26 million. And if you have that, you're allowed to have some different accounting methods than are allowed if you don't have that lower level of revenue in place. That includes being able to use the cash basis of accounting, to skip having to worry about 263 Cap A's Unicap rules, and also to take advantage of some special inventory rules under 471C. And finally, if you're a contractor, to be treated as a small contractor, which means you don't have to use the percentage of completion method. Well, those proposed regulations we discussed back then. And we talked about a lot of things in there, including their impact on the syndicate rules. So we want to kind of be aware of how that's going to go. Now, most comments the IRS rejected. So specifically, we talked about the fact that for inventory, we talked about their theory about if you had supplies, you're going to treat your inventory like materials and supplies, that the Blue Book had stated that you could use de minimis election under the IRS regulations to essentially write off everything that had an invoice price of less than $2,500. We told you back in July that the IRS said, no, that doesn't work. These regulations are not going to change that. It doesn't work. In the preamble, they spend more time explaining why they went this route and why the Blue Book, as far as they're concerned, is simply wrong. They do acknowledge the Blue Book this time, but they actually tell us why they think it's wrong, so we don't get that. There is one thing they did give on inventory I should mention, and that is that they agreed that if you are using the materials and supplies method, that you do not have to worry about direct labor costs in your inventory numbers. So that might help in some cases, especially if you have inventory that normally would accumulate a lot of labor into the cost of the product, that labor would not go into that. That was clarified in the final regulations, they specifically say that if you're using essentially the non-incidental materials and supplies, which they call NEMS, now they have that as an acronym, using that method of handling inventory, that you only add direct materials. It says nothing about direct labor into your costs. They did not change their deal about when you use the material, so it still has to be sold and delivered to a customer. In fact, in the preamble, they say delivered. In the actual reg, they kind of imply delivered, but they also maybe don't. It's a little more open there when you read the reg itself. They also did not agree to make any changes in major ways to the syndicate rules. Now, you may remember we discussed the syndicate rules because that has issues with 163J's interest limitation. Again, you don't have to worry about that limitation on deduction of business interest if your average revenues are less than $26 million, unless you're a tax shelter. Now, as we discussed back in July when the proposed regs came out, the tax shelter rules are kind of unique, and there are three categories, but the one category of tax shelter that's probably going to cause the most headaches is this category called a syndicate, which is a situation, where over 35% of the losses incurred in a year go to limited partners or limited entrepreneurs who are generally defined as those that do not materially participate in the business, subject to some special rules under 1256, I think it's 1256E3, that has a list of related parties that as long as you're kind of related to somebody who themselves is truly active, that you'll be considered materially participating even if you aren't. So it's an interesting aside there. But if you have that 35%, then we got to worry about the interest. And as I noted at the time, a lot of real estate partnerships that are, real estate partnerships in, we'll call it the more traditional sense, not the real estate partnership where we just have three guys that own a, S corporation conducting a business, and it owns its own and they have the building for it that they own personally. And that's a partnership. That's not really a problem for the syndicate rules because those three are going to participate in the activity. But the bigger problem is if you have somebody who goes out and finds and builds or finds real estate projects and then leases them out for a long period of time. So they're constantly holding and managing a bunch of properties, and they get investors to come in and form a partnership where they always hold a minority interest, but they're the manager, they run it. The money people just put money in for the most part. They have bigger problems with the syndicate rule. And that rule they specifically rejected calls to write some sort of special small business exception. Now, I kind of understand why, because if you think about it, Congress already said you were a small business if you were going to get this particular exception where you could use these accounting methods, but they still said you couldn't be a tax shelter. So the IRS said it seems like we'd be kind of undoing or mechanically undoing the law that Congress passed if we said, well, of course, small businesses can use this, but they can't be tax shelters. But we'll just say if you're a small business, you're not a tax shelter, so you'd effectively write that provision out of the law. And the IRS felt that they really can't just write that provision out of the law. So we ended up with that. We did get one back off, though, and this is really important for this year. What the IRS decided was the way the rule works is, in order to be a syndicate, the pass-through entity needs to have a loss for the year. And that's because the rule says if more than 35% of losses are allocated, even though go back to the law far enough, says allocable, but allocated, which would mean we have to have a loss. Now, the way the original proposed regulations said was you could elect to test yourself for whether you were a syndicate by looking to the prior year for revenue. Okay, but if you did that, that was permanent forever, right? And the IRS couldn't let you off the hook for that for 5 years if you asked them, and after 5 years, you have to ask them, get their permission. That was pulled in the final regs. The final regs say that is now a year-by-year election, which will be really important. Let's say that you had a really bad year in 2020. So in 2020, even though you've been profitable for decades, in 2020 you suddenly have a loss, and because you had money investors who get more than 35% of the allocable income and loss from the entity, now you got a problem. You show a loss this year, more than 35% goes to them, you would be a syndicate. Under the original proposed regs, we could skip this year, 2020 could be skipped, or I should say, what'll be this year we're filing. We're always in tax a year behind. So essentially, last year, which is 2020, we would be a syndicate, we would meet the syndicate test. Now, we could get out of that by saying go back to 19 when we were profitable. That's great, but then 21 would be a syndicate again, because testing it based on the previous year would take us right back into 2020, which is our loss year. And again, our problem is that may be a one-year standalone loss year because of COVID, but we're stuck with it. Now it's year-by-year election, so as long as the pandemic situation straightens out in time for that business to be profitable in 21, then we will not have a problem. We will never be a syndicate because we would elect for our 20 return, use the prior year for testing, but for the 21 return, we won't. That's a very nice change, especially given the impact this year of the COVID-19 pandemic. Now, these regulations officially take effect for tax years beginning after January 5th of 2021, because the regs are going to be published in the Federal Register on Tuesday, January 5th. Now, what that really means for calendar year taxpayers is they won't take effect until 2022 because they didn't make the register by the 31st of December. Now, of course, the catch is the law's still there. So the IRS says you have basically two what we'll call safe harbor choices where the IRS won't challenge you. One is you could just start using the final regulations as written immediately and go ahead for every year from 2018 forward, ever since the TCJA rules came in, or you can change it up and you could use the proposed rates, which aren't radically different, but they are somewhat different. So there are a couple of minor changes. Obviously, choice 3, which will not be protected, is that you could ignore all of these regulations and use a reasonable interpretation of the provision. So you might be able to argue for at least one more year that the de minimis election should work, but you're going to be arguing against the IRS analysis in the preamble that says, no, it always has excluded inventory items, and these are still inventory items. So you want to be aware of all of those issues. Again, you have a choice, obviously, beginning in 22, that calendar year 22, that choice goes away. And clearly, any fiscal year that begins in 2021 is going to be a year that began after January 5th. And so therefore, we're going to start seeing those fiscal years stack up. So we're going to kind of go from January through December year ends, where this is going to kick in every time once we get past December of 21. So interesting aside. The IRS also went back down and said, hey, you know what? You know about those estate tax returns and the old closing letters we used to get? Well, there's proposed regulation 114-615-16 that was issued on New Year's Eve, and it goes back to the old thing we had with estates. You may remember the days, it wasn't that long ago, where anytime you had a 706, the IRS would eventually issue an estate tax closing letter. Now, it wasn't a traditional full-blown closing letter, and they emphasized that discussed in these regs, but it was essentially a letter that often probate courts would wait for. The personal rep or the executor would wait to receive it to keep from being potentially on the hook. If there was an IRS assessment, the IRS would say that unless they saw some fraud or something else of that sort, they wouldn't open it back up. So it gave a level of protection. Now, the IRS has been stating that, look, we got too many things happening these days, and we've lost people in the estate tax realm. And in this preamble, they actually talk about the fact that they're also getting a lot of portability returns, at least Not really a lot when you look nationwide at how many people there are in the country, but a lot for a part of the agency that's been pared down to handle what would be the taxable estate returns, and now they're getting these portability returns. My guess is the portability returns probably still are heavily coming from the states that still have some sort of estate tax, because it's kind of a gimme. If, let's say, we're doing an Oregon estate tax return or a Minnesota estate tax return, well, we have to basically do all the work. So the 706 or the portability election is kind of a gimme, but that's still enough to keep them busy. So they've decided to have time for the automatic. So what they tried at first was to convince people that you could just request a transcript. And the transcript with this code, they claim would be equivalent to that. Well, judges and everybody didn't quite buy it. People still wanted something. So they started accepting requests specifically. You had to wait until essentially the transcript showed the activity was done, and then you had to call the IRS and make a specific request. Now, with the pandemic, they changed that over to, as I recall, a fax-only system, and that's where we sit today. Well, they've decided that instead they really need to start charging for this, so there'll be a user fee system. Now, the good news is this should be a more direct and formal system than what we've had before, this kind of informal follow-up. And the proposed regs tell us the cost of this will be $67. And, basically the estate was required to be involved with this. They're the ones that would pay for it, the ones that have a right to get it. But the theory is you'll be seeing this. Now, when will they finalize this? We don't really know. This isn't something they're going to tell us right away. But, if you're doing these estate tax returns and you're going to need a closing letter to close out the estate, they want to have that. Be aware that we are going to be coming up eventually on a fee for this. Again, $67 is not a killer fee in any realm of the imagination. And I'm going to assume that if you have an estate we're worried about a closing letter on, $67 is probably not going to break the bank. But it is something to be aware, and at least until, if you have a chance, you might try to get a closing letter in before that request, just so you're not out the $6-7. So we'll see how it goes. Well, let's go back now to a case we talked about in March of 2019. This is the case of Gregory versus Commissioner. The Gregory case, it was a published tax court decision, 152 TC number 7. Came out on March the 13th of 2019. And we talked about it at the time because the issue is that the taxpayer had essentially moved, and there was an IRS exam, and eventually the notice of deficiency got sent to the old address. Taxpayer was not aware that a notice had been issued until after the 90 days had passed for the taxpayer to file a petition in tax court. And the IRS said, well, sorry, guys, you're too late. Taxpayer said, wait. You guys knew we were at a different address. In essence, this shouldn't count. Well, the tax court in the original case we talked about back in 2019 ruled that, sorry, guys, you have to follow the IRS's specific guidance. And they pointed out that while at one point, you could, filing an extension or filing a power of attorney, I should say, was found to qualify as giving an update on the address, the IRS had changed the instructions to say specifically it doesn't do it. Now, the facts in this case are kind of interesting. And this is where, when the Third Circuit reverses, they're going to pay a lot of attention to this. And they did the reversal, case number 192229, which was issued on December the 30th. The issue in this case, what had happened? The taxpayer in October, the CPA had filed the tax return, and according to the Third Circuit, the tax court, I don't recall ever said this way, but the Third Circuit opinion did, the CPA accidentally left the old address on the 1040 for the prior year. The client had moved. Sometime after that, the exam went in place. The CPA sent in a power of attorney. The power of attorney had the client with the new address on the form. So we had a client with new address, so that was on there along with the CPA's address. They also filed a extension for the next year's tax return, put the new address on that. And the CPA in the exam had told the agent up front that the taxpayers had moved. So that was specifically discussed with the agent on the exam. At the end of the day, it didn't matter to the IRS. They sent the statutory notice of deficiency to the old address, claiming that was the last known address, because that was the last tax return for which we had a address on it. That was the address on the last filed return. They said the extensions don't count. They don't update addresses. Neither does the power of attorney, and the tax court went along with that. So they're saying that in essence, the taxpayer should have filed the 8822, which was the change of address form. They didn't file that, so IRS says, sorry, we sent it to the last known address. Bad, tough luck, you didn't see it for 90 days, but tax court has no jurisdiction. Well, the Third Circuit didn't quite buy this. And what the Third Circuit said was that, yes, we understand this following the strict rules. And they're saying there is something to be said for that gives us a sure, black and white, there's no question that this is one that go to tax court. This is one, sorry, you're too late. But they said there's been a history of cases, though, that have looked at facts and circumstances to determine whether the IRS reasonably was aware or should have been aware of the new address and failed to follow up. And the Third Circuit decided in this case, they were aware of it. Potentially maybe it's not enough to just have a power of attorney. Maybe it's not enough to just send an extension. But when you did both of those before the notice was issued, and the agent had been informed directly and admits that she'd been told about the new address, they're saying, IRS, you really have a responsibility at that point to update it and not hide behind the fact that the taxpayer didn't file an 8822 yet and hadn't filed a 1040 with the new address on it yet. And so the Third Circuit said, tax court, you're wrong about this, right? In essence, the IRS did not behave reasonably by using that address on it, so they kicked the case back to the tax court and says, okay, guys, now go forward, which probably means that the case will now be dismissed because the IRS didn't get their assessment out in time. Probably the statute has expired on the assessment in the interim while we're waiting to go to tax court. So there's a decent chance the taxpayer wins straight up. So let's talk about what this means in a couple of ways. First thing, regardless of if you're in the Third Circuit or not, it still makes the most sense to do the 8822. The reason why is we know that the IRS will recognize that. You won't have an argument with the agent. Now, I understand the Third Circuit has reversed this case. And if you are in the Third Circuit, which is New Jersey, Pennsylvania, Delaware, and the U.S. Virgin Islands, then yes, under the Golson rule, the tax court will respect this. So the tax court under the Golson rule cannot simply say that you didn't follow the IRS's required mechanical guidance in the revenue procedure, so tough luck, it was sent to the last known address. They're going to have to do this sort of facts and circumstances inquiry as well to see whether the service knew or reasonably should have known about that. But you can bet 100% that in every case this comes up, that the IRS is going to try to argue why your case is not like Gregory and why it doesn't work that way. Secondly, for the vast majority of us we're working with a client who is not in the Third Circuit, not in Pennsylvania, New Jersey, Delaware, or the U.S. Virgin Islands, if in that case, what we're going to have is we still have a published tax court decision. That TC in there, 152 TC number 7, it's still a published tax court decision. It was a reviewed decision of the U.S. tax court deciding on the novel question of whether it was a, follow the revenue procedure exactly or tough luck. And the tax court said that's the way it should be. Now, like I said, in the Third Circuit, the Golson rule is going to say they're not going to follow that. But outside the Third Circuit, there's a very good chance the IRS or at least the tax court, I should say, and the IRS will continue to follow the rule. In essence, Gregory is still good law, like here in my home circuit, the Ninth Circuit, and all the other circuits in the country, until the IRS ends up getting called on the carpet again, where they ignored that kind of detail and and sent it to an address where the taxpayer didn't see it for over 90 days. And then we're going to see, what does the Ninth Circuit think? What does the Fifth Circuit think? What does every circuit think except the third? And that will be something where generally, if the tax court has gone to 3 circuits and none of them are backing them, they're all going the other way, then they do tend to back down. But for right now, don't assume this is going to work outside the third. I mean, raise the issue. Why not? What have you got to lose? But I would suggest that you tell your clients, regardless, 8822 makes sense. In essence, sometimes the best way to win the fight is to avoid it entirely. You're going to win on this and be able to challenge where you want and be able to challenge it as you want. If you do the 8822, we skip this whole argument about whether you have the ability to challenge it anymore. So like I said, really important for clients to understand they probably should be doing the 8822. Okay, well, there's a thing that you might say with tax law and tax issues. If some analysis comes up in a way that appears to be absolutely absurd, then it's probably right as far as the tax law goes. And sometimes that seems to be how it works better. Well, if that statement's true, this email is the perfect example of a wildly absurd result. I don't know that it's true because it turns on something that I think the courts might look at differently, interpretation of what Section 7508 Cap A actually does. But we'll have to kind of take a look at this. But this is Chief Counsel email 2020-53013. By the way, 53, it means that we had an extra Friday this year, right? We had 53 Fridays in 2020, I should say last year, because those 2 digits after the year is the week number in the year. So yeah, we got to 53. Now, 366 is not evenly divisible by 7. So there are a few extras in there. And this year, Friday was one of the extras. Now, this issue arises due to the IRS's issuance of let's say, give you extra time to file the 1040 this year. Remember, it was ruled using their authority under Section 7508 Cap A. The IRS essentially was able to say, if you filed on July 15th, we're going to treat that as if you had filed on April 15th, right? So it would work for any dates, late filing, for any penalties, for underpayments, any of those things. Your payments that went in on July 15th to be treated as if they went in on April 15th. So that was the key. Now, the question that arose in this email, which is interesting, is, okay, this is a future problem, but let's think about it now. How long do we have to file a claim for refund for that taxpayer who filed the return, not an extension, but went ahead and filed it on July 15th this year? When does our statute for claiming a refund expire? And they don't mention it in this email, but the same question would obviously occur to you. When does the statute expire for the IRS to assess tax? And it's an interesting analysis because of how they look at this. So let's talk about this. 6511A generally states that the statute is 3 years from the date the return was filed. If the return was filed before the due date, then it would be basically that due date. So if you file a return in April, let's say file a return in February, let's say 20th, you have one of those clients filed early, so they filed it at February 20th this year for the 2020 return. That's going to be deemed filed on April 15th of 21, and you could file your claim for refund, therefore, 3 years from that date, which would get us to July 15th of 2024. But what about last year? Well, they're saying that general rule under 6511A would recognize the fact that that return was filed on July 15th and would kick it forward 3 years to July 17th because the 15th is Saturday in 2023. And so you could file your claim for refund by July 17th of 2023, and it would be timely filed on that section. However, you may not get much back from it. Why? Well, because there is another provision of 6511B2. It says that if you're filing that based on the date of the return, 3 years out from that, your refund can be no more than the amount you paid during that same 3-year period going back from the date you filed your claim for refund. Now, the law normally says that estimated tax payments and withholding are deemed paid on the due date of the return for this statute's purposes. However, if you go on extension, if the return is extended, then that date, that deemed payment date, would move forward to the extended due date. Okay, so fine. But now the IRS says, here's the catch, and this is where I think the courts might disagree. The memo says, well, this wasn't really an extension under the extension provisions of the code. This was simply a moving, playing with the due date weirdly. So you had until July 15th. It would be deemed timely, but you didn't actually have an extension to July 15th. So if you just filed on July 15th because they gave you that 3 months, well, if you don't get your claim for refund in by April 17th, April 15th is also on a Saturday, just like July 15th in 2023, you're late. So if you file that in May, you're timely under the first category, but late under the second. But now to add to absurdity, then they did, parenthetically, they mentioned this. However, let's say your client, because some people did this because, hey, belts and suspenders, you went ahead and filed an extension on April the 15th of 2020, right? You already had it filed. And the client still goes ahead and files on July 15th of 2020. In that case, because they had an extension, they would be able to get the money back if they filed by July 17th. In essence, moved it out 3 more months. Filing the extension extends the statute for them to get a refund. Now, if we talk about claims here, if we talk about what about the IRS assessing tax? Well, that second category of payment date, when was the money paid in, is going to be relevant there. So my guess is the service's position would be they're going to have till July 17th of 2023 to come after any taxpayer that filed by July 17th, that filed on July 17th of 20. However, you will not have a right to go for refunds at extra 3 months. So just keep that in the back of your mind. Whether the service is right about that or not is open to question. But I wouldn't be surprised they take this position at that point. And if they do, then yes, a client could get whipsawed in an exam because, sometimes we're thinking about we might have a claim for refund or not, or maybe the service is going to prevail. And, the statute's coming up. Realize your statute ends 3 months before theirs. So you may need to file that claim for refund and tip your hand a little bit before the agent finishes up their work on the exam, because you may have to act 3 months before the agent does. Again, is it right? I don't know the courts are going to say this was not an extension for these purposes. But I understand the logic, and yeah, just be aware that's how they're looking at it. Finally, we have here an issue here, something that's always popular around these things. Whenever I do an article on this, well, a lot of people always check in on this. We're going to talk about cryptocurrency. And in this case, the Financial Crimes Enforcement Network, FinCEN, they issued FinCEN Notice 2020-2 on New Year's Eve again. New Year's Eve was popular this time. And they mentioned in the notice that they had previously held, let's say that you have an account held by you have cryptocurrency held in an account with a vendor who is located outside the U.S. They had ruled that that was not an account that had to be reported on your FBAR form. And, now if let's say they offered other investment vehicles and you had, let's say, a money market account in there or a standard brokerage account, then yeah, you'd still report the account on the FBAR. But if all it was holding was cryptocurrency, they're saying not an issue. We don't worry about that. But the IRS has definitely had increasing interest in going after these virtual currencies. And you remember last year it was on Schedule 1. This year, it's going to be on the front page of the 1040, just below the address, asking about virtual currencies. And it appears that Treasury is going to bring this up. Now, remember, FinCEN is the Financial Crimes Enforcement Network. My guess is the IRS interest in cryptocurrency is heavily driven by their interest by criminal activities being conducted with cryptocurrencies. And they want to be able to, do the same thing and move it to the FBAR form, because they have a lot of cases that when you file an FBAR form and you say, no, I don't need to, when you not file an FBAR, when you do Schedule B and you say at the bottom of Schedule B, no, I don't have any foreign accounts and no, I need to file the FBAR form, they've really hung people on that and gotten the big penalties out of them for that. Well, I think this is looking at doing much the same thing, setting them up for perjury by having them answer the no to hide that account. And then they discover it was hidden. They discover it in some way, shape, or form. And if anybody asks how will they discover it, my answer is almost always you'll probably leave them information that lets them do it easily. That's usually what happens in the real world. The answer is, yeah, don't play that. If your only defense is hoping they don't find it, then if they do, the fact you were trying to hide it, yeah, we have case law on that. It turns really badly at that point. So they're going to do it. Now, what they say in this notice is they plan to issue regulations that will require that account holding only cryptocurrency or virtual currencies in an offshore location will have to be moved to the FBAR, right? So that's there. Now, the only catch is right now, they didn't tell us when they're going to issue these regs or when these regs would be effective. Just a notice that they plan to do it. So keep your eyes on it, because we don't know how far out in the future it's going to be before they do that. And obviously the date when it takes effect, that's going to be kind of a big thing. So keep your eye on that. Now, other things coming up, you're pretty much aware. This week I am going to be doing, this week 3 separate sessions on the new tax bill. On Thursday, or I should say, on Wednesday, get my right days, I'll be doing a session in the morning at 8:30 a.m. at 8 a.m. Mountain Standard Time for the Idaho Society of CPAs. I'll be doing one at 12:30 p.m. that day, Mountain Standard Time, for the Arizona Society of CPAs. And then on Friday, I will be doing a 4-hour session beginning at 8:30 a.m. Hawaii Standard Time for the Hawaii Society of CPAs. And later in the month, on the 14th, as I recall, get my dates right, I will be doing the same session for the New Jersey Society of CPAs. So we're going to be doing that all about the new PPP loans, the PPP2 loans, and all the other stuff. And I'll be doing a course on Thursday for the Oregon Society of CPAs that's going to be on real estate in partnerships, partnerships in real estate. We'll have an 8-hour course on that. So I do have a few courses coming up here this month. Keep track of it. We'll see if we add more of the PPP loan program and new tax bill provisions. Those are all coming up. It is official, it appears now. Senate has adjourned. So the $2,000 checks would have to go on to the next Congress, who's probably going to be tied up with other issues this week. You've probably been reading about it. So we won't probably be seeing stuff from them anytime soon. Yeah, we're probably going to be the $600 checks, which have now begun. I don't know if they mailed physical checks out yet, but they definitely have been transferring into bank accounts. So those are coming. If clients have them coming, they'll see it. Remember, at $600, fewer of your clients are going to get these because of the way the phase out works on this. The phase out is 5% of the excess over those limits. Obviously, back when it was $1,200 for each, and it was going to take longer to phase out than when it's $600. It's going to get only halfway as far. Instead of getting $24,000 out from the limit, you get to 12. So a single taxpayer will get nothing once their AGI gets above $87,000. Previously, it was $99,000. So again, that sort of thing's coming. Also, remember, these payments only go through the 15th of January. If they're not there by then, the client has to wait for the return. And will they actually try to get a $2,000 check out? Your guess is as good as mine. I have a feeling, considering all the stuff's going to go on this week and the time it would take to get anything through, my guess is it's probably not going to come through until after the inauguration. Would be the best guess I would have, because, and the reason why, if the Republicans win either seat in Georgia, then we're probably looking at having to try to negotiate a different package, right? So it won't be a clean bill because leadership did not want a clean bill voted on this time, and it appears very likely leadership will be the same in the Senate if we have Republicans in control. If it's the Democrats, well, it's kind of obvious, they can wait for Joe Biden to show up and pass a bill with other things they want, and so it's easier to send it to somebody who is going to sign it than somebody who might not. So yeah, we might see that delayed. So, and also, they really can't get it through until Biden is brought in, because this is the one thing a vice president does, is they break ties in the Senate. And obviously, you would be switching your tiebreaker from Mike Pence, who we would presume would side with the Republicans, to Kamala Harris, who would, we would suspect would side with the Democrats in a case like that. So it's kind of interesting. So anyway, we got stuff to watch for here on taxes. Lots of things happening. Keep your eyes out for Small Business Administration guidance. I heard an unconfirmed report today from one financial group that they believe the SBA is going to open up on open up on January the 11th to start taking applications and processing loans for the program. So get ready to go. And whatever happens, we'll talk to you about what happens. We'll talk to you about developments we have in the coming weeks, a week from now, on current federal tax developments.